All right, hey guys, Sam with you here. We're Thursday morning, midday. It's January 25th. And the members' request winner today, we had a couple of them. OmiseGo against the US dollar tether on Bittrex. One of our members' choices today. So now we've done this coin recently, so I still have my work on this. Just to give you some perspective on it. So here's OmiseGo. This relatively new project. It's only 7 months old, but we're already, Genesis date is 7 months ago. So we're already at 1.7 billion, 58 on the metric score here. That's a good sign. 51 here in the development community. Major crypto. So we look over to where it's trading. Now, what's interesting about OmiseGo is that it's fairly evenly split between the dollar and Bitcoin. Somewhat unusual. So we look here. So for the against the dollar, the bulk of that is on Bitfinex, but members looking for it against Bittrex, where we have to trade it against the dollar tether, which is what I have over here. So we've got enough volume here that we can do some technical work here now. Again, so we're gonna focus here on the right edge of the market. So and I'll post this for the members here. So if you want to use this as a template, you can go through it. This was a little tricky actually in here to get a clean count on it. But what we end up with, we get a leading diagonal. So we've got in blue here, we get a 1. Here's our 2, the big 3 down for the 4. We overlap the 1, and then we up we go for 5 to give us a clean. It's a 5-wave structure. It's a leading diagonal, which we can find in a 1-wave, so that makes sense, right? So given that we have a completed 5-wave structure, now we look for those high probability zones for the second wave. We know a second will be anywhere from 50 to 786, so we actually are right in the pocket here. So we get this, this pretty abrupt spike down here, and we can see there's actually 5-wave subdivision within that C wave. So, I don't know what caused that. It could be something related to, who knows, more sellers than buyers. But whatever it is, we get a reaction out of it, and then we come back down and we revisit the little golden pocket here to give us potentially a nice 1-2. And yet again, maybe we've got a 1-2, 1-2, and you say, well, wow, Sam, that's a lot of 1-2s. Well, if you think about where we're trying to get to, we're going to need those 1-2s to get there. So if we look at this, now, one thing I wanted to just try and emphasize here, because I've had some confusion with some members about this. So what you're looking at here, so this is just the straight algo pull, right? So this algorithms will typically be buyers at the 50 all the way down to the 618 where they will defend it. If it breaks the 65, it's not that they will short it. They don't go, oh, we're reversing and selling. But what they'll do now is they'll wait for the next 50. So they'd go here, which is why you often run into resistance on the way back. Okay, so and you can see it right here. So it goes up to the 50. Now, the algorithms that are written to sell it there, sell it. Now, that target is down here. But, it's just software, guys. They don't always get their target. They're going to keep flipping until they get on the right side of it. Eventually, they'll be there for the move. That's just the way, just how it seems to work. Eventually, you're going to see one of these pop and get to the negative 23. Maybe it's this one. Maybe it's that one. Right now, so you see, what we're trying to do is weave the Elliott wave in around what the algorithms are doing, because we don't, for most of us, don't have the resources to just keep flipping, all right, and sell it, buy it, until you get on the right side of it. So we use the Elliott wave to see if we can find an Elliott wave structure that allows us to kind of weave in and around what they're doing. Right? You see what's happening there? See, this is where they flip. Then they sell the 50. Now there's going to be another set of algorithms that are going to buy it here to defend the 618. You see, it's just it's not the same. It's not the same group of traders, right? So you have competing forces in there. Again, it's just software. It's not crypto, Billy Bob selling here and crypto Jimmy John buying it here. It's just software doing this. So you can the thing about them is that they leave tracks, right? So you can see what they're doing, and we're just trying to get behind them. So if and when they get the move, that we're on board. We just want to surf behind them in their wake. So that's the target here from that group of traders that and the algorithms that have been written to buy the 618 and defend it all the way to the other side of the 65. Now this group here is trying to blow past this resistance, because remember, it's going to come up here. And just as you have this resistance here, you're going to have it again here. It's got to get through that for them to flip. Now, if it flips, okay, stay with me. Now, if those that sold it here don't get their target and we get through this, then they flip again. Okay, then they're waiting for the next 50 to get on the right side of it, because eventually they're going to get the right side of it. That's why they make so much money. That's why it works. That, you know, if they wouldn't keep doing it if it wasn't profitable. Do you see that? So it's just competing forces, competing algorithms that eventually everybody gets on board and it's going the right way. So these, they may not get their target. These might get it. Then they're going to flip. Maybe. So that's how you end up with an Elliott wave count in here that we're trying to get behind. So when I say there's a 1, 2, maybe 1, 2, again, we're just trying to get behind the algorithms and eventually get on the right side of it here. So again, I almost think of it, it's like we're trying to ski behind them, right? So we're just trying to let them pull us along the way, knowing where they're likely to take their profit and where they're likely to reverse. Do you see that now? So given that, right? So if you allow for that, okay? So you can say I'm crazy, but certainly a lot of evidence to support this. Now, put that aside for a second. Now, if we think like an Elliott wave trader, what do we have here? Well, we've got a leading diagonal. Remember, the foundation of Elliott wave is really, yeah, there's complexity to it, but the foundation is relatively simple. We trend in 5s, we correct in 3s, whether it's up or down. Okay, so we've got a 5-wave structure, so we defer to the longer trend. Rather than just catching every swing. We're not trying to do that. One, we want to be long in crypto, right? That's the nature of where the market is and where the cycle is. We want to be long if we can, rather than just sell every 50. So we let this happen and we say, okay, now can we use the Elliott wave to our advantage to try and get into the big move, knowing what the algorithms are likely to do. So we can look at this and go, okay, ABC, here's maybe a 1, 2. I'm right into the golden pocket. I know algorithms are going to be active there. And we get this reaction. So if we're thinking like Elliott wave traders, so the first thing we want to do, let me clear some of this up. Okay, so the algo targets are right here, right? So it's, you know, as I teach you in the training, right? These should be every time you make a Fibonacci pull, and you're pulling for retracements. The algo targets are going to come up automatically. So here are the targets: -23, -618, 100. Now, when we combine these two approaches, you'll find that they're very close. So as an Elliott wave trader, we're going to look for the relationship between the one wave projected from the second wave, right? From this low right here. So do you notice how they line up here? Okay, so here's the thinking Elliott wave. Here's the highest probability zone for the third wave. It's that box that I often talk about here. Statistically, not because I like it, because the statistics support it. So here's the highest probability zone for a third wave if we're going to get a third wave. And we don't know that we are, but if we're going to get it, that's the likely target statistically. So what else do we have to hang our hat on or hang a trade on? Where does it go most often? I mean, it's as simple as that. Well, so if we're going to get that, well, then we're trying to get in here. That's some juicy upside. If we can get on board for that move. Now, note what's happening along the way. Here's the first algo target, very close to the 100. Why do we care about the 100? Because in Elliott wave, as I've mentioned before, the third wave doesn't have to be the longest wave. It just can't be the shortest wave. So we want to measure because, you know, as we're going here, we don't have yet a fourth and a fifth to measure against. The only thing we can measure is against the first, which is why the 100 is important to us, because if we get one tick through the 100%, the length of the 1, then we have a potential wave 3. Not certainty, the potential for a wave 3. But, I mean, it could top right there. It would still be a wave 3. It could go to the 1272. Happens a lot. But note how these line up with the algo targets, right? That's not accidental, right? And very often you'll see the 1618, 175 box right in line with the -100, which is the extreme algo target. Do you see that? Now, what if we come here to the algo target here and we don't get through it? And so and typically they'll front run their profit target. So they'll front run on the -23.6, meaning we don't get to 100%. We just top right there. Do we still have an Elliott wave count? Well, you theoretically you could, Because again, 3 doesn't have to be the longest, just can't be the shortest. So you could come down into the 4 here and then go up into a 5 as long as the 5 is not longer than the third, right? If this is what we get, that's still a valid Elliott wave. That's still a 5-wave structure. It's not pretty and it's atypical, but it would still be a 5-wave structure. So the next thing you would do if that completes, okay, if that just, again, of course, was hypothetical, the next thing we're going to look for, we're going to draw to the absolute high of it just to get, wrong tool. So hypothetically, if we get up here and we complete up here, the next thing we're going to do is look for the 2. Do you see that? Because I've got a 5-wave structure, and I'm going to expect that 2 to come. I'm going to look for a 3-wave structure to correct it. So if I put the wave on it, that's what I'm looking for. I would still have a 5-wave count, long as the 5th is shorter than the 3rd. You see it? I've still got it. So why does that matter? Because the next thing I'm looking for is the 50. And you can say, well, but isn't that what the algorithms are going to do anyway? Yeah, that's exactly what they're going to do, which takes me back to we're just trying to use the Elliott wave to get in behind them, but reduce the probability of using the wrong pivots. You see, that's the idea. So where are they likely to buy it, and does that make sense in an Elliott wave context? Because if it does, then we know that likely if we're going to get a 2 here, we're going to expect 5 waves coming out of that. So it helps us kind of weave in and around what they're likely doing because, again, we can't just buy, reverse, flip, now I'm selling, now I'm buying. We don't have the deep pockets. Well, maybe you do, but I don't. I can't just switch on everyone, and I don't want to be short in crypto, at least not now. You see, so that's why we're combining the 2. So let's go all the way back to where we started. Take all this off. What are we looking for? What's the target? Because all we have now is a potential 1-2, and I like that I'm in here. I've had a little second visit into my golden pocket. Makes me all the more confident in it because it's getting tested. It gets tested and it holds. Look at the reaction. Now, maybe it gets tested again, but right now that looks like I've got an ABC, nice, clean, everything I'm looking for, all the subdivision I want to see. I got 3 waves in my B. If I open that up, there's 5 waves in my C. You can see it here. 1, 2, 3 we go down. Here's the 4. We come down for the 5. I can't ask for it any better than that. That's as good as it gets. That's textbook Elliott wave pattern right there. So what's the assumption? Well, of course, I'm going to assume that if I've got a completed ABC into a 2-wave, I'm looking for a 1, 2, 3, 4, 5 to start my 3rd wave. But look how high my 3rd wave is here. It's not likely to go 1, 2, 3, 4, 5, right? So there's going to be subdivision along the way. That's just the way the market moves, right? No absolutes. I mean, I suppose that's possible, but unlikely that we're going to just go straight. But in crypto, we've seen it, right? So we've seen crazy things happen. But most likely, we're going to see that subdivide along the way. So we're looking for, within this 3rd wave, we're looking for subdivision. So maybe it's 1, 2, 3, 4, 5 to give us a 1 wave on our way to the 3rd. Now let me lower that degree so it makes sense. So we'll go down to, we'll go to subminuet. Okay, so maybe, so here's my 3rd target up here. No reason to assume it won't get there until it doesn't. That's the high probability zone. Why would I say, oh, it'll never get there? So why would you assume that? The first thing I would assume is, well, at least I got good probability on my side to get there. Now, I don't know how it gets there, but I know I got a target up here. So all I'm trying to do is find a low-risk place where I can get into this market, knowing that that's the potential, and not have to risk too much to try and get on board that ride. So if we get this, right? So what would that likely be? Do you see? So it's waves within waves. So if I were to get that to set up for me, let's change the color so it makes sense. If I can get that, that would likely be just the 1 wave. Do you see? So it subdivides yet again. So maybe we look like this. So it's the wave within wave theory, right? So maybe I don't get all the way there. Again, I'm just hypothesizing here a potential roadmap. So if I put you see that? So what I'm trying to get is, so I look here and I go, well, maybe I can get the 3rd of the 1st. Well, do you want to chase the 3rd, Or do you want to wait till you get the first here and try and get the second, because that's going to be a bigger move? Well, that's trader's choice. But there's certainly opportunity here. If we've got a 2 and we're going up for a 3, well, nothing wrong with a little, a little single there. That's not a get-rich trade, because the expectation will be at some point we're going to give back a little bit as profit is taken, and then we're going to get one more push up here. But knowing if we get that, where's the wave 2? Wave 2 is likely to give back 50% of that. So are you willing, this is the choice you have to make. If you were to get that, are you willing to give back at least 50% of your profit, if not taking you underwater on that trade, just for the potential for that to follow that roadmap? You see, that's why having target, if you're going to trade this way, you got to make that choice. You got to be conscious about what you're doing. It can't be just, oh man, I caught it down here, so I'm just going to sit. Oh, well, you could do that, but eventually you're going to have one of these trades where it's just going to roll over, and you're just going to get wiped out. And you went from being in potentially what was a great looking trade, now it's turned into a loser, right? Because you don't know this roadmap is coming. It's just the potential for it. And so as long as the potential remains there, we want to try and get in and ride it. So if you were to buy it right here on the potential for the third, at some point you're likely to get this third to top and roll over as people that caught this take profit. That sets up the fourth. Now you don't know for sure. You don't know for sure whether you're going to get the fifth, because this could just roll over. If I can do that. If I can get that tip there, that can just roll over and go down. We don't know that we get the fifth, because that could just turn into an ABC. And maybe we've just got a larger correction. Maybe you end up with something like this, because that was a pretty steep one wave we had. Maybe we get A, B, C. See, here you don't know. You can't be like, oh, sweet, I'm in the third, I'm on my way all the way up here. You don't know that. You don't know until you see what happens right here. Do you get the fifth? So understand. So you got to take the calculated risk there. The odds are that we're putting in a 1 based on this pattern, based on this good subdivision, but that doesn't mean it has to happen. So this is a calculated risk. I'm willing to risk X amount of dollars for the potential for this to come up here and finish this 5-wave sequence. So nothing wrong with that trade. That's a moneymaker if we see it. But if that tops there, if we top there, then the 2 is likely to be a minimum 50%. Again, just like statistically, this is the highest probability zone for the third. The 2 wave is going to take back 50% of that. So if you bought it here to catch the fifth, okay, again, this is a good example. So if you bought it here, so here's the 1. We don't overlap the 1. Note here. Okay, so we have a clean 5 wave. We get a nice 1 wave that doesn't overlap it. Okay, so we come down here, we pop the 50. Well, I guess actually we'd be down a little bit lower. So if we were doing this, so you bought the 38 and we come up for the 50. Well, now now we're looking for the 50% of that entire move. Let me take that off. It's getting hard to get the hooks. There we go. So if we get this pop up here for the fifth, well, you're going to give back at least 50% of that move. Well, you don't know. The odds are you're going to give back at least 50%, but you could give back 78% of it and still have a valid count. So that's your decision. Do you want to take profit up here? Do you want to ride this out and say, well, I'll just average down. I'll just keep buying it because I'm so confident that I'm eventually going to get up here? That's not what I would do, right? So I would rather, I'll take the calculated risk here for the fourth, trying to get the fifth, but I'm going to take profit here and get out of this trade. And then I'm going to wait and see if I get a good 2. What's a good 2? A good 2 is going to have 3-wave subdivision rather than just a straight shot down. Straight shot down is probably the A wave, just like this was. Because you could have looked at that and said A, B, C. Oh, there's the correction's in. Off we go. Right? So there's a good example of exactly what I'm trying to show you. You could have said, oh, there's ABC, so my correction is over, so that 1, 2, well, that's where, again, that's the point of knowing where these pivots are likely to go. So if you thought that right there, okay, so you're looking at that, you're going, okay, I've got my correction in, there's my 3 waves. Sam's always telling me about these 3 waves. You can look here and you go, ooh, wait a minute, I know statistically that my second wave is much more likely to go between the 50 and the 786. So even though I got a 3 wave, that doesn't, I'm not willing to take a calculated risk here. Additionally, given the length of time of that 1 wave, does that look like that would correct it? No. This looks much better. There's a symmetry here. So this little ABC gives us an A wave. Then we get a 1, 2. Oh, hey, is it 1, 2, 3, 4? Are we going up for the 5th? It rolls over. So just as I was saying here, you could get this as an ABC and roll over. Look what happened here. If you were buying it here thinking, oh, I'm off for the 1 of my 3rd, well, you got crushed. Happens all the time. Incomplete. There's a sense of proportion to a good Elliott count that you can use to your advantage. This is likely the first push down, likely the A wave. If it subdivides in 3, you can just look at that. Does that look right? Does that look like that? That little move right there is going to correct all of that? Maybe, but not likely. That looks much better. And look where we go. We go almost to the 786, where we know, again, a 2 wave is likely to go. So now looking here, again, this is the point I was trying to make, is are you willing to give back 50% of it for the 2? Or do you just want to let this finish so that you know you've got a good 1 wave, so that you've got a good clear 1, 2, 1, then you're looking for the 2. And I'm looking for that 2 to subdivide in just the way the last one did. I'm looking for that. Can I get that? Now I have a whole lot more confidence that the trade I'm making is putting me into the 3rd of the 3rd. That's your money maker. That's the wave you want, the 3rd of the 3rd. Right? That's the big one. Right? Do you see that? 3rd of the 3rd. 4th is going to come, most likely. So do you, if we get something up here top, we get a little divergence in the oscillator, maybe we hit the 1618 of this 1, 2. It's going to roll over. You're going to expect 3 waves into the 4th. Are you going to stick around for the ride all the way up here to the 3rd? You know, those are the choices you got to make along the way. Maybe you take a partial here, let this come back down. You reload here. You add back. Now you're adding with house money. Because you know, so why would that make sense? If you bought it here, the probability here is that you're more likely to retrace just 23 to 38% of it, not all the way down here. Could happen, but now look here. See, this is the advantage. Again, if we're in a 3rd, we can't have a diagonal. So it can't overlap the 1 and still be a valid count. Do you see that? So it has to hold here. So the max that wave 4 could retrace and hold as a valid impulsive wave, which we need in the 3rd wave, is to the 50. So you could be a buyer here. That's where I would start buying it, looking for the 4th to do what it does statistically, more normally at the 38, knowing it might go to the 50. So what else can I do? Maybe right there I'm going to start maybe I put a pitchfork on it and say, oh, do I have some market geometry? Is there a relationship between the length of the 2 to the length of the 4? Do I get 3-wave subdivision? So do you understand the point being that I've got very tight risk-reward controls here? Because if it overlaps this, I'm out. I'm wrong. Trade is wrong. I no reason to hold it beyond that because I made an assumption that I had a 1 wave, this is a 2 wave, and that I am going to stay impulsive if I'm going to have a 3rd wave. Can't have a diagonal. So I know if it takes out that 1-way high, I'm wrong. Trade's wrong. And that's the power of Elliott Wave, is it gives you rule sets. It gives you some structure in the midst of all the chaos to go, well, okay, I'm wrong. Wrong. Hypothesis is wrong. Roadmap's wrong. Got to reevaluate. What else could it be? Then you don't know. You've got to wait and see. See what it could be. What would fit? What would play? Right. So that's the whole idea I'm trying to communicate to you, is that this forced structure that makes you that forces you to make decisions about where you're right or you're wrong is truly powerful to a trader. Where you're just otherwise. How are you going to make sense of it? How are you going to organize it? It's just, I suppose, right? You could just take the algo approach and just say, well, every 50, I just buy every 50. You better have deep pockets to do that. All right, guys, I went a little long there. Okay, I'm going to wrap it on that.